Okay, we can start now. Thank you very much. You guys can, the audio is okay? Okay, thank you very much. Great. Um, first of all, thank you very much to FXstreet for allowing me the opportunity to share information with the trading public. It's always a pleasure to share whatever information I can. And I certainly enjoy it. I hope that you find value in it. Today, we're going to talk a little bit about the pricing engines. Some of you may have seen some of the information before. We're changing it up a little bit. Each time we present it, we kind of get into details in different areas. But I want to talk about the impact of the pricing engines and FX volatility. And hopefully that with some of the information we provide here, you can potentially integrate it into your trading. For the intraday models, the long-term models as well, we trade price behavior, but for the intraday models, we trade off of this information. We obviously understand it to pretty reasonable depth of understanding, as you'll see as we discussed it today. And I have always been a price action or price behavior trader since 15 years now. And what I've found is that once I established myself and connect with price behavior, I can't connect with anything else because with price behavior, I can immediately identify the changes in liquidity and the volatility throughout the day, hour to hour, week to week, and as the macro phases change as well. Connecting with price behavior really helps me to stay on top of the changes very quickly. So we're just going to start with just talking, first of all, about the structure of it, the pricing engines, and then just have a look at some price behavior as it relates to what we've discussed. So thank you very much. I execute through the bank. The bank is making money on the transaction. I am a client of the bank and they make money by selling me liquidity, just like the broker does with you. So there's of course the spread, or they might charge you based on volume that you trade. They're selling liquidity to you. So on the buy side of the flows, degree where it is the sole purpose of their transactions is to realize a capital gain, while there are others who really have no understanding of the FX market, yet they still require to make FX transactions to conduct their personal day-to-day affairs, business needs, travel needs, what have you. So you have a virtually endless continuum of demand in the FX market. And remember that every single asset class of anything is priced in a currency. So is connected with the foreign exchange market in some way, even your day-to-day activities. So it's virtually endless. Now, what the banks will do is the banks will have access to the aggregate price. So each of the banks will be hooked up, of course, to the interbank global feeds, as you well know, by an aggregator, a third-party aggregator that will package the pricing, and the bank will, of course, have access to that feed in order to understand what price is being traded at, but the bank also will have their own liquidity inside the bank. And this is where it gets very interesting. I realize that I'm probably already telling you something that's something that you already know, but it's important to understand the basic framework before we get into the details and its impact on the price movements as you identify them on your charts and while you're trading. So so the bank. So if I have one bank as my prime brokerage, as my prime broker, I simply will establish myself at a bank, and through the credit that I built up at the bank, one bank will do all the due diligence on me, virtually an enormous scope of due diligence on my business to allow me to trade FX through them, but it is through that due diligence that allows me credit lines with a multitude of other banks. So I have two options. I can either trade through the bank, or I can trade through the interbank aggregator liquidity provider. So those are my two options, remember. Now, so the bank can either offset my demand for liquidity either inside the bank with another client, or they can actually hold the risk. And so we'll talk about that in a moment. Um, so it would work like this. So let's say, for example, I'm a client of the bank, and so I can either access my liquidity through the bank. The bank will either offset my demand with another party that's trading through the bank. So the liquidity in each independent investment bank is really quite rich. And there are different levels of volume in all the different banks, of course, and there are some that are preferred over others. But that's one way that they can sell me liquidity. The other way is that um, the bank can actually take on the risk and hold my positions. So if I'm selling euros and buying US dollars, the bank can take the euros. They can either filter them off into the interbank market, they can filter them off into a counterparty that's inside the bank, or they can hold the risk and they can redistribute it later. And when they hold the risk, there's a um, there's an impact on pricing that we'll soon discuss. So these are the different options that are available. Now, that is if I choose liquidity within to be provided from within one single bank. Okay, so if I'm trading FX and I want competitive pricing, then that brings us to another type of environment. So just to look at this whole structure of the system in a different way so that we can understand when we start to talk about its impact on pricing, we have a little bit of a better view on it. Let's say, for example, I'm a fund manager. Well, first of all, let's talk about where your prices come from. So there are a multitude of investment banks in the market that deal heavily in foreign exchange. And then there are third-party aggregators. For example, Hotspot, Integral, Currenex, FXall would be a third-party aggregator. The third-party aggregator will have in its facility the ability to take the feeds from all the banks and they create what's called the best bid, best offer pricing. That's why if you have a good feed, you'll often see pricing very, very close to no spread at all, sometimes inverted spreads, but typically consistently very, very, very narrow spreads. And the more banks that are connected, usually the more competitive the pricing. So uh, the aggregator will have agreements with, for example, a reseller and a broker in your case. So you would be set up with a broker, and the broker will sometimes refix the pricing in order to deliver it to your desktop. Okay, so that's the very simple way that prices are delivered to your desktop. And now what we want to talk about more importantly is why we see some of the price behaviors that we see. We want to look at the other side of the equation. So where the larger institutional funds are flowing and some more details of what goes on inside the bank. So if I am managing an FX fund and I set up prime brokerage at one bank, say I'm a private client of the bank or an institutional fund manager of the bank, um, I have I can set up prime brokerage with one bank, and I've got the discretion to select best bid, best offer available. So I can actually see what every one of these banks is currently quoting, and they will be off slightly. Sometimes they'll be off by several pips. Sometimes they'll be off by a larger amount, sometimes by a lesser amount. It just depends on how active the market is. But I've got the option to select. I can buy with one bank, then I can sell it off at another bank. So you can imagine what type of opportunities can be created with this type of flexibility involved. Now, these are a little bit more sophisticated setups, but that option is available. So now what I want to do is take you to the next slide to talk about um, its impact. So actually, one more thing before I discuss this. If I buy or put in bids at one single bank, the bank, remember, the bank can either uh, I can either go to the bank and I can put it into the interbank market, or I can be offset with a counterparty from within the bank, or the bank will hold the risk. So if I sell euros, buy US dollars, the bank holds the euros. The bank may hold the euros because they see flows that are pushing euro higher, at least for a short period of time, so that they can take them on at, say, 123.50 and get rid of them at 123.60 or 123.70. And we're going to look at that pricing in just a moment. So remember, those are the options. So if the bank has a view or sees momentum, they may hold the risk, which will open up one side of the market. Sorry, spelling here. One side of the market. So let's say, for example, uh, uh, I sell euros to the bank. The bank takes on the euros, and usually before you get a price move like this, liquidity really drops off. But the bank holds on to the euros, and they start to see the euros. Uh, um, the euro starts to move a little bit. Well, if the bank holds on to the euros rather than puts them out into the market, then that's actually going to create a liquidity opening in the market for price to move. So, uh, uh, because the bank's not selling them off. So this can actually compound the move, which is actually, we're going to talk about its trigger in just a moment, but this can actually compound the pricing move. Maybe we'll come back to this slide in just a moment. So this picture will more or less summarize the point that we're trying to make. Now, you've all seen price move, let's just have a look, from a point of liquidity stability, and price starts to accelerate out of that area. Let's call this a 1-minute chart. Price accelerates out of that area and then starts to settle down again. And so we're going to talk about the function of liquidity as it impacts price spikes or price runs or price movements like this that are illiquid and somewhat inefficient. So let's just slow it down a little bit. Now, taken from our previous slide, if I am a fund manager and I have a prime brokerage account with a bank or dealing more heavily with one individual bank, remember, I have best bid, best offer discretion. So I have a multitude of banks that I can choose my liquidity from, or I can put it into the interbank market where the liquidity will come from any of the counterparties. Or if I put it into one single bank, the bank may take on the risk themselves. So let's just consider that price is moving. We have stable liquidity flows moving within a range, and the market is just more or less moving fairly passively. Let's just say it's in a sideways market like this. And so let's just say that there's flows coming in between, say, 1 and 10, and we're not going to put any number on it, but we're just saying on a ratio basis. Say they're coming in at 1 to 10. So let's say we have a nice even flows of 10s. Then all of a sudden, one bank puts 300 out into the interbank market. So they start to roll out 300. Okay. Well, what that's going to do is while the other banks can still be operating from a primary liquidity base at a certain number or a certain range, a numerical range, once that block comes in, what happens is the algos in the banks, so the algos in the banks will actually trigger a self-protecting mode because they don't want to get clipped. So they don't want to be offering prices at a lower level while prices already started to move higher, offering prices at lower levels that can be bid on and then can be sold soon afterwards at a higher price. So what they have to do is they've got to protect themselves, and they do it by creating it triggers a self-protecting price moving algo. So effectively what happens is the larger block that will come in will trigger a price move. So when the price move gets triggered and we start to see price accelerate up, and we're going to look at many examples of this, as we start to see it accelerate higher, it actually creates a vacuum, and the bank's bids actually need to start to move higher and draw, or the bids and the offers actually have to get sucked up the market like a vacuum, and they will draw the orders up behind them like a vacuum. So it actually starts what we call a price run. So the banks create this mechanism because they have to protect the risk by moving the base bids and offers uh, higher, even though there's a liquidity at a base price. So we'll look at this on a chart in a few moments, just so we can see what that looks like, so you can relate to it on your own charts. Now, as price continues to move higher, the risk protecting algo draws prices higher, acting like a vacuum, which is seen as a spike move in price. So, so you'll see that price will have a core base volume. Once it triggers, it will start to wind up a little bit. Sometimes it will pop at its base. Then the as new orders come in, they've actually got to move in the banks. They'll actually take on prices that are higher than the available offers. So the offer will continue to jump up or draw the bids higher, so that the price move will actually continue and compound itself, because all of the banks need to start to kick in. Now, eventually the bids will dry up, and it creates a void in price to the liquidity base. So this vacuum creates this price move, and if it is a sharper move in a thinner market, then you'll see typically a price that runs a little bit further. It's more inefficient. The bids will eventually dry up, and price will draw back down towards the liquidity base and stabilize. Now, because there's a difference between a price move where sellers come in and move price down, and a price move where the bids actually create a void in the market and start to draw back. So this is what we're referring to here when we look at price spikes, and they typically will they will overrun themselves. So so what it might look, if we look at this in a different way, a liquidity and price movement, it might look like this. So on this side of the market, you have the bank that has internal dealing. So the bank offsets client A with client B, or they hold the risk. Now, on the other side of the market, you may have bank prime brokerage, where you've got an aggregator of some 10 or 15 banks. Now, if price is trading down at a base, let's say 130.17 or 120, let's just say 130.17 on euro dollar, and then a larger order gets chunked into the market, all it needs to do is create a little bit of a trigger at the right time in the market, which we'll discuss. And once it starts generating that price move, we'll see a little spike. So price, in this case, let's say it runs up by 8 pips, the engine will draw price up, but all day long, we get these little movements that will move price up 5 pips, 8 pips, and they draw back in, because the bids will draw the near-term liquidity up, then it dries up and it comes back to the base and starts dealing at the base. Now, the aggregate feed will typically draw price up, but it can be triggered by the interbank dealing. Now, if a large order comes in and the bank decides to hold the risk, they're taking on the order, but they're not putting it off into the market, which typically would stabilize liquidity. But by holding on, it will create a void to one side of the market, which will push price to the weak side of the market. Okay, so that's why you get these movements all day long, which we can actually just pop over now, have a quick look at on the, for example, if we look at this is a pound dollar 10-minute chart. And typically what we see is the market literally all day long Usually the price characteristics are that liquidity will drop off, becomes very, very quiet. In this case, liquidity draws away from the market. We get an order comes in, triggers the movement, and we start to see price draw up. Now, it will usually run up. In this case, we see a bit of a more of a macro move during Asia. Price runs up, continues in the price run, then it draws right back to the base liquidity. Very, very, very common behavior. So as before Europe opens, liquidity drops off, price runs up, liquidity void, price draws back to the base liquidity where it can start to build up a little bit and start the trend moving. So I'm just showing you it actually happens all day like this, here and here and here. And I'm just picking some of the obvious cases where liquidity drops off. And here we get a price run up, the bids dry up, and it draws all the way back. So we use a concept called fractal where it does it on short term as well as in the long term. But nonetheless, you can understand the basic concept. So if we look at pound dollar 1 minute chart, we see the same behaviors. Liquidity drops off, becomes very, very quiet. We get a volume surge in the market, price runs up, then it draws back to the base liquidity before it can build up and get bid up again. And again, it happens all day long. So here it moves very, very thin move to the downside. Price draws right back up to the base liquidity. And once again, the move was preceded by a very, very, very quiet 1 minute period, in which case liquidity is less present in the market before the price move gets initiated. So back to our example here. So if we look at, again, let's look at it a different way in a 1 minute chart. So again, you have client A goes to the bank, wants a price, offsets it with client B, or they hold the risk. Liquidity is dropping off, so it starts a price move and it triggers the entire aggregate feed because the other banks need to protect their risk against such a move. Otherwise, one can go into their bank, get an offer, then sell it off at a later time, but in a short period of time at a higher price. Again, you see a price run and price draws back to the base liquidity. Price run, price draws back. And again, we see this all day long. Just a couple of examples of some aggregators. So you'll just notice that we watch the aggregators separately as well, and we'll see who's bidding and who's offering what. We're looking at the spreads, and we're watching the changes in the spreads as sometimes when news hits, when price gets quieter, when we see a lower tick frequency, we're also watching the changes in the spreads. And obviously, we will watch the aggregator, best bid, best offer, and we'll also be watching on the quote board as well. But here's a list of sort of contributors just to give you an idea of the extent of the contributor pool. So more discussion on the engine. So one institutional engine generates a response from all others. So once one entity starts to push price out, it actually kicks in the protective pricing engine on the other banks as well. So the integrated feed will spike up. So it compounds the price movement. This is why currencies tend to overshoot, leaving a liquidity void in its trail. So let's just look at it a different way. Let's say that we have relative volume stability. Let's say that orders are coming in between 1 and 5. Usually you see it coming in between, let's say 250 and 10 million, depending on the currency pair, depending on the liquidity, of course, of the pairs. And so when we go into the market, it's important that what we do is we'll deliver large orders into the market in smaller blocks with a price spread tolerance. So on euro dollar, for example, if you take a 200 million order, you pump it in blocks of five, so that it will draw liquidity out of the market and doesn't create any kind of ill effect on our own prices. So we're not really going to move the interbank market, but will affect the prices that we receive. So let's just say we're in a state of relative volume stability. Usually what happens is we often see the price tick frequency and also the movements really start to back off. When that happens, look out, because you're probably going to see a price move. And because usually at that time, liquidity is drying up on either side of the market. So then when we get a little bit of a volume surge, so let's just say it looks like this, where we get this volume surge of, let's say, on a relative scale, let's say you're doing 1 to 5, maybe 100 comes in, then what the interbank pricing system has to do is it's got to break up the order. And to break it up, it needs to find liquidity. So to find liquidity, it's going to have to move slightly higher. And if the bank is holding risk in any capacity, then it's going to actually open up the offer side even more. So it's got to split up the orders, and it's going to have to start a price run. So it actually creates a trigger on all the banks to go into this self-protecting mode, and you're going to have to bid even higher for your prices because they force you to. And so that creates a price move. It often becomes very inefficient, and usually near the top, we actually start to see some price jumps near the top. Eventually, this vacuum dries up and the liquidity becomes a little bit more stable again, but it's left a liquidity void in its trail, and usually we see price will draw back. Now, this surge can be anything anywhere from 3-5 pips to 30 pips. And so we watch this very, very close, and we're usually trading into these moves. I mean, we're not trading in every one of them. We only pick a few a day, but this is the anatomy of the type of move and the price behavior that we like to look for, that we're trading into to take advantage of the inefficient movement. So if we look at it yet another way, let's say we have relative volume stability. Usually we start to see the price behavior really drop off and get quiet. Now, this might quite simply be an event. And then we see it get bid up a little bit. It's quite quiet. And then let's just say that the average on the sell side, we have basically a stable average of, let's say, blocks of 5 coming in. And it's just a number so that we can understand this conceptually. So let's just say we have a fairly even number. When the larger order comes in, it's going to have to put the order into the market. It's obviously got to find liquidity, and what happens is it will force price to draw up in a market, regardless of how thick it is or how thin it is. If the relative ratio of orders coming in to offers, like for example, if you're near a data point, typically there's a lot less volume on either side of the market, so price will move even more, of course. And so, but typically what we see is the bids will draw up, it creates the vacuum, and eventually the bid vacuum runs fairly dry or becomes quite imbalanced, and the move back, all I've done here is I've taken a price spike and split it in half. And the move back is a result of the void in the bids, or the bids having dried up. You've still got your liquidity base, rather than selling coming into the market. There's two different scenarios. So we like the scenario where prices run very, very inefficiently. Typically, the top of the move is very, very thin, and we usually see price jumping because it's got to jump to find new levels of liquidity to offset uh, the bids. And we'll see price typically draw back because there's also an entire emotional state of the market that is shifting. During this move, it's shifting, and then during this move, there's a different state of mind in the market during this move as well. That also feeds into the overall price move, and then price will draw back. We see price stability at the volume base, and then usually we get a pretty good response there as well. Okay. Um, so another simple example of this is you've got relative volume stability, and this can be on a 5-minute chart. It can even be on a 60-minute chart or a daily chart. That's why we call it relative volume stability. Price drops to a low level of tick frequency, lower volume, and then which usually is a state at which we see the market subject to a price move. It may be data, it may not be data, because we see these moves all day long. It's the same pattern. We see it all day long that are not data related. So it's not just data. We're not just talking about data spikes. So you see a classic example of price spiking up. It's certainly the result of the pricing engine. Price draws back to the liquidity base, stabilizes, and then it can start a run of more substance. So this run, for example, would be more volume efficient than this run, for example. It's more the type of reaction we're looking at. Now, when price runs up inefficiently, we're also looking for levels at which there might be some liquidity pools where this brings in a whole different dimension to the discussion point, is that when we get the price run, if a bank dealer is holding risk, they will often hold it and get rid of it at points where there's liquidity pools, points of resistance in the market. And when they get rid of it, that of course too will create make the market price more vulnerable to a downside move in this case. And so I think that's what I'll do is I'll just take it over to some live charts so we can have a look at some examples. So we see it like, for example, we see here, we saw the price move, price stabilizes. Even though it stabilizes, it still draws back to the point of release of this movement. Let's move over to the euro. We'll look at the 1-minute chart, I think, just because it gives us more of an indication of what we discussed today. We use this really on all time frames, but you'll see that, for example, here, so you notice how the volatility and the liquidity was really dropping off right here. When it gets narrower and narrower, doesn't matter what direction it's pointing, whether it's up or down or sideways, its narrowest point is usually when liquidity is dried up. It's most vulnerable. So we get that price run. It goes from 93 down to 85. So then it draws back up to this liquidity base and then continues its move. In the meantime, each time price runs, no matter how much or how little, price will run. As price moves out of the dealing range, the exposed element becomes a new dealing range. So this exposed element, it trades in this area for a while, either near term or longer term. Price runs out, feeds back in to the liquidity base, and continues to do so fairly passively here. But even though we have price stabilizes, even on the smallest level, we see price sideways, drops off, runs, comes back to liquidity point, runs out, stabilizes for a while, moves, comes back to the liquidity base. Okay, so it literally happens all day long. Which ones we trade, we are of course highly selective. We pick typically, the high probability response points, but we see these movements literally occurring all day long. We'll go back to the pound dollar, just take it back to the 10-minute chart. I don't want to get into too much detail of it on the higher time frame than that, just because I don't want to confuse things too much. So again, if we take uh, here where price, this is getting right around when Europe gets busy, right around 0530. We start to see the books open up. In this case, it's 0550, but we usually start to see the books open 0530 to 600. And we see very thin market, price runs up, has a second leg. Um, it draws back, even though the difference between these 2 points is literally like two pips. Um, but we see a multi-stage run, price draws right back into the liquidity base. If you've got a nice efficient movement where price moves, you see how price moves, consolidates, moves, the new price run spike here comes back, fills, and then price drops off, moves to a new level, comes back and modestly fills it here. But when it gets really, really thin, like this doesn't last long. The bids dry up, price draws back to where most of the liquidity occurred, and it stabilizes. And so it's creating movements and reference points from one dealing point to the next in reference to its most recent activity as well as swings earlier in the day. Okay, and price levels earlier in the day. The market spends a majority of its time trading sideways on all time frames. It's called fractal. Um, and so when we see these price moves, we like to see an exposed, if we're going to trade into a move, we like to see a nice exposed leg with the anticipation that price will draw back to the last base point of liquidity. And I'd have to show you sort of in live uh, uh, time to see a price surge to give you an example as to what we trade into. And that's of course, it's far too long for today's discussion, but we just wanted to take a little bit of time out and give you a bit of a sense for where these price moves come from. So just remember a couple of things. When you see liquidity dropping off and becoming very quiet, you can anticipate an inefficient or exposed price run like this. And if you do, you're probably going to see some filling stage of it filling back up or drawing back to the base point of liquidity at some point. And of course, there's many, many different variations of it. And it's something that you don't want to go and implement into your trading model immediately. You need to go through the process and engage and really get a feel for it. Okay. So for example, if the pound dollar uh, drew back lower, we would look for a reaction at 70. So if we had a nice inefficient price run that moves from here, we would look for a reaction at 70. Of course, barring any data or any situations, we'd probably see a reaction here. So the reaction might be 10, 15, or 20 pips. If price moves higher, um, if we had, because if we sell, let's just say you use this resistance. If we sell into this resistance, it's not, the resistance point is not necessarily the critical element of the decision in the trade. A very, very large contributing factor is the anatomy of the move and the level of inefficiency of the move into that level with the anticipation that price will draw back into the base of liquidity and create some stability before price continues to say move higher. So we always need to see price move higher in a relatively efficient manner in our trends, because we have efficient trends and inefficient trends, which is another subject matter. So really what we're looking at here is we're not picking, we are, for on an intraday basis, we are volatility traders. So we're non-directionally biased. So we're not looking for sentiment for the day or trend for the day. we're trading volatility. While we do have a very deep understanding of what's going on fundamentally, what's been driving price, what rate spreads are doing, what's influencing price for the period, what data points are out, how price reacts to data points. We are generally non-directionally biased. There are certain circumstances where we will stand out of the way, like when the central bank speaks, we stand out of the way because the central bank can open the door on liquidity and literally remove the cap one side or the other. So, anyway, this let me maybe go to some questions here. Who are the other who moving prices besides the bank? Well, I mean, the bank is the seller of liquidity. So if I'm managing funds and I'm using the bank as a liquidity provider, either as a prime broker or just getting my liquidity from the bank, the dealers are usually not going to hold risk on liquidity that I'm putting in the market, but they'll hold risk on entities that are hedging and whatnot. Can you give a best bid, best offer example, please, for buyers or sellers? Well, basically, best bid, best offer pricing is really your broker is using an aggregator that's aggregating prices. Now, your broker may change the pricing a little bit as well before they filter it out to you. They may have different levels of pricing depending on how much volume you trade. But among the range of banks, the aggregator has an algo that takes the best bid and the best offer available, and it delivers it to you. So one question regarding fractals. In a sudden spike up, when would you consider that the top of the fractal has been completed? I've been watching all your webinars from the free user section, but I didn't fully get when it's time to sell into a fractal. Well, okay, fractal is a pattern of self-similarity. So for example, I mean, we don't use the fractals that's on MT4, that's just support and resistance. I'm not sure where that came from, but fractal in its geometric sense, non-mathematical, but geometric sense, is patterns of self-similarity repeated at a multitude of scales. So in other words, this chart, while I have told you it's a 10-minute chart, it could very well be a 60-minute chart. So on a relative scale, we see the same patterns and we'll trade the patterns very, very similarly. So for example, if the pound runs up to, let's say, 57.20 area as an example, this type of behavior, we'll see the same type of behavior on a 1-minute chart. So we may have relative inefficiency on this 60-minute chart. So we may actually find that this level is quite appealing in anticipation of a reaction or a change in liquidity flows, particularly if we see a pretty good level up here where we're probably going to see a bit of a shift in liquidity. And if we take it down to like the 1 minute, for example, if we see a nice price run, so you see from 90, if we get that up to 20, then to me that is fairly appealing. But we'd like to see this remain weak and run up to 20. So our definition of fractal is in the geometric sense. Why does price draw back to base liquidity? That gets into sort of the element of the core liquidity. Remember, not everybody in the market is a speculator in the same sense that a day trader would be. So the base liquidity, there's a couple of representations of base liquidity. It can mean two things. Number one, there's two things that I look at base liquidity. And let's just say we're taking this base right here, is I look at the potential number of transactions or the psychological connection with the area, as well as the relative volume. So in other words, what time of day did it build this base? and how potentially sensitive the area, what was the type of behavior like in this area as well. So I don't want to make something that is actually reasonably um, um, understandable. I don't want to make it sound too complex. That's why I don't want to throw out too much kind of information, because uh, I wanted to try to stick to the liquidity in the simplistic sense, because it really, once you study it and go in and do some exercises, it's not as complicated as you think. But if you're accustomed to mathematical models, then certainly it can be a bit confusing. Um, uh, Chris, I'm not a scalper. Okay, um, so I'm not sure exactly. I don't have time to go in and look at the exact time of the movements you're referring to, but I'm not a scalper. We sit all day long and we'll watch the price behaviors and price movements, and they can make sense to us, but we're only picking the prime movements, really just the movements that we think are really really high probability of good reaction points. Okay. Um, So for intraday trading, I typically will get my levels off the 30 and 60-minute charts, but my entry is coming on the behavior on the 5 and the 1 minute, or you can even use the 2, 3, or 4-minute chart. It doesn't matter. Like, it doesn't matter whether it's a 34-minute chart or a 47-minute chart. Price is price is price, and the time frame literally does not even matter. Um, but I'm going to take my levels off of the foundation of the 30 to 60-minute time frames, anywhere within there. Okay. So the steps that I take is, number one, I'm looking at levels. Number two, I'm looking at the price, the anatomy of the price move and the price run, which I described here. So for example, this type of price run, um, I want to see sort of a nice little price run, either like this, or it can even be, actually, that's an extreme example. This is a 60-minute chart, so it's not a great example anyway. But I'm looking for a price run, say, like on the euro, you're getting a run that's coming from, yeah, about 88. We're at 97 now. So, as you all well know, price moves up and down, up and down, up and down. And so, um, so we're looking for the price run out, taking an entry, and with the anticipation that price will draw back to its liquidity base and capitalizing on that movement. We're not looking to pick tops and bottoms, and I didn't want to get into a discussion on how I trade, because that would take 4 days. Um, it's more understanding the liquidity, the pricing engines, and the movements that you may be able to integrate into your way of trading. Okay, so because the one important point that I want to make is that uh, when we present a subject matter, you don't want to get caught up with looking and listening to the subject matter, thinking, just tell me, when do I get in? When do I get in? When do I make my trade? I realize that that's important in your trading, but you need to understand the concept first. Go in, take the concept, interact with it in a real market environment, then determine what aspects of the concept you can relate to, build a trading model around it, or integrate it into your trading model, uh, um, uh, experiment with it, and determine whether or not it has some merit or some validity within your trading model, and then use it. You need to go through things very methodically. Okay, you can't just randomly go out and look at a concept and bang, try to implement it the next day. I mean, this type of thing you should be able to see literally immediately when you leave the webinar. Go watch your charts. You should be able to start to see this behavior straight away. But to connect with the behavior, you're going to have to interact with it for a while, and you're going to need a bit of a plan to interact with it as well. Okay. You see, I mean, you got this blue line here. This blue line right here, I literally don't even use it. It looks nice, but I don't refer to it at all. It's extremely, it's not even secondary or tertiary. It's just there for more or less for good looks. And every time we do a webinar, somebody asks about it. But but it's on some charts, it's not on others. It's just in my templates and happens to be there, and I don't even see it really. So thank you very much, FX Street. We appreciate it. Thank you for your kind attention. I hope that you were able to find some value in the information.